Hello and welcome to Sectors Up Close. I'm David Pollard. Today we're talking US banks with Randy Watts, Senior Portfolio Manager at O'Neill Global Advisors. This week, JP Morgan, Citi and Wells Fargo kick off earnings for major banks under a cloud. The relentless rise in US Treasury yields is hitting their loan books, as well as forcing them to pay more for deposits amid what still has the potential to become a slowing economy. And while the treasuries held by banks are accounted for as hold to maturity, it doesn't mean investors are any less nervous about the impact of sharply rising rates on the financial system, following the spectacular collapse of a handful of regional lenders earlier this year. Regional lenders too also continue to feel the squeeze, despite backstops provided by the Fed's Bank Term Funding Programme, established in March. Well, O'Neill Global Advisors Senior Portfolio Manager Randy Watts is with us to pick through all that. Randy, many thanks for joining us today. According to a recent report, paper losses on US banks' bond holdings are now close to an all-time high of $400 billion, an epic sum. That must be worrying for investors, isn't it?
It's worrying, but to put in perspective, it's really only an issue for the banks if they're forced to liquidate those bond books. Obviously, Silicon Valley, First Republic, some of the banks earlier this spring had problems when they had large deposit withdrawals. But for the banks, especially the large banks like a JP Morgan, that's unlikely to have to see that kind of forced liquidation. They'll be able to hold those bond books to maturity and they'll be okay. It's only when they get into a major mismatch between assets and liabilities that that's really going to be an issue, even though with a lot of those positions, if mark to market, are currently underwater.
Well, the other point of concern that we mentioned in our introduction there is, of course, rising rates, which are driving some customers away from banks in search of other assets and CDs and so on.
That's absolutely a problem. What's happening right now is customers are taking money out and they're putting it into money market funds, they're putting it into CDs, they're putting it into bond mutual funds. That's really pressuring deposit growth. Some of the very large banks will see some deposit growth because they've been beneficiaries of the problems at the regionals. But for the regional banks, deposits are going to be under pressure. Also, to add to that, the fact that the banks have to offer more in terms of savings rates means their net interest margins are getting squeezed and there's pressure on net interest income.
Now, the other running theme this year has been banks' exposure to the commercial real estate market. Wells Fargo said in its last earnings statement that it had a nearly $1 billion provision for credit losses, primarily related to office loans.
So let's put that in perspective. $1 billion reserved for a bank the size of Wells Fargo actually, frankly, isn't that big a deal. So the really large money center banks actually don't have a dangerous amount of exposure there. The exposure is really at the regional bank level. Regional banks actually make the majority of commercial real estate loans in the United States. And on an individual basis, there are some banks that could see problems there. Obviously, particularly office rents are under pressure. And in the US, people have still not overall returned to a 5-day-a-week type schedule in the office. So that is a risk. I think as we go into bank earnings at the end of this week, we have to really differentiate between the money center banks and the regionals. I think the money center banks are going to be relatively okay and have decent quarters relative to expectations. But I think it's possible there could be some negative surprises on an individual regional bank basis.
So with that in mind, are regional lenders, given the scale of the sell-off this year, are they getting to a point where they are attractive or are they still a bit too dangerous?
You know, they're not quite there yet. And normally when the Fed raises interest rates, deposit rates for banks don't peak till a quarter or two after the Fed either stops raising rates or starts cutting. But they are very inexpensive right now. On a price to book basis, the regionals are trading about 0.8 times price to book. Normal major historical bottoms happen around 0.7 times. So we're not quite there yet, but I do strongly suspect there is going to be a major buying opportunity in banks at some point in 2024 as we move through this Fed rate cycle.
So regional lenders looking potentially attractive. What about other picks in what is, after all, a very diverse sector?
I do think that JP Morgan has done well in this crisis. They're very well reserved. They're very well run, and they've been the biggest beneficiary of deposit flows out of the regionals into JP Morgan. obviously, much like Goldman Sachs and Morgan Stanley, they're going to have some pressure this quarter due to slower business at their investment bank because there's been very few IPOs. There's pressure on M&A because of rates, et cetera. But I do think the major banks, JP Morgan, Citi, et cetera, are, as we roll into 2024, are going to have an emerging story on cost cutting. So I think actually the mega banks can actually have a much better start to the year next year as they try to reduce costs to help their margins than the regionals.
Okay, Randy, it's been good to hear your insights today. Randy Watts, Senior Portfolio Manager at O'Neill Global Advisors, many thanks for being with us. And that is your roundup of US banks. I'm David Pollard, and this is Reuters.